we're going to talk about three big themes that you want to touch on today. One is debt and capital flows. Where are we in the world today? The second is a question of rising social and political tensions. Again, a big issue. And the third is the one that may be top of everyone's mind today. It's certainly top of the FT here, Evergrande, which is China. But let's start with capital flows. So when you look at the world today, drowning in debt, $290 trillion worth of debt in the global economy. That's 350% of global GDP, which, by the way, is almost a third bigger in terms of proportion relative to 2008. What do you think is happening in the world today?
Well, those three things that you referred to are all connected, but those three things, the zero interest rates, the amount of production of debt, and the amount of production of money to pay for the debt, the conflicts, the social conflicts, and then the rise of a great power to challenge an existing great power and the existing world order. The last time that happened was 1930 to 45, and then that's what prompted me to look back. And so the answer to that is the same. So it's mechanics, I think. They needed more money, but they don't have any money. So the central government has the ability to tax and send out checks, but it doesn't have the ability to create money. And the central bank has the ability to create money. So when everybody needs money, the government sends out the checks, and it borrows money from the Federal Reserve, and that has happened in history. So in that 1930 to 45 period, that happened, and it happened many times before. So now you have to understand the mechanics of that. First of all, politically, it's the no-cost thing. Nobody's blaming anybody because we didn't take money from anybody. But that money then goes through the system, and it goes through the system for financial buyers. They get a lot more money. They get a lot more credit. And with that, they don't want to own cash because they'll have a negative real interest rate. Cash will certainly have a significantly negative real interest rate. We'll probably have nominal GDP growth will probably be 7% this year. In other words, inflation will probably be in the vicinity of 4 to 5%, and then you get real growth on top of that. You have nominal GDP growth at 7%. And so you have a zero interest rate. So that mechanics is what we have to understand in terms of the reflation move and so on. That's happening. The decreased value of debt, don't hold your money in a debt asset, and hold your money in almost anything else. And that has effects longer term on the value of money. If you look at the future and the projections, there are supply-demand issues. So, but that is connected to the political because everybody needs more money. And then of course the rise of China as a war, trade war, technology war, geopolitical war, capital war type of environment, could be even a military war, it's conceivable. That's the environment that we're in.
So a lot to unpack there. Let's start off with a couple of questions. Firstly, do you presume that the Fed raises rates in the next year, and can the market sustain that given this rising tide and rising dependency on free money?
You will probably have what I call a mock charge that as we look ahead, there's going to be, despite all this fiscal stimulation, there's going to be a lesser amount of it. And so there's a fiscal cliff that's going to come in the next year, slower input. But there's going to be a much higher level of inflation. So that I suspect that there will be there'll be tapering. And maybe, I couldn't tell you whether there's a minor rate rise. Because the duration of assets, and that also means interest rate sensitivity of assets has increased, that it won't take much of a rate rise to have a significant negative effect on asset prices. And I think that would produce a correction that would then respond to another round. So if you look at interest rate changes, Fed policy changes since 1980, every interest rate peak and every interest rate trough since 1980 through all the cycles until we hit zero was lower than the one before it. More stimulation took. And then if you look at since then, when quantitative easing was the way of easing, every quantitative easing stimulant was greater than the one before it. So I think that we're going to have that cycle continue because there's going to need be another big round of that, which means that the number one thing is don't hold cash for a move. You may have a correction. I'm not saying you don't want to have a correction in other markets, but to have a good balanced portfolio and really not to own cash and not to own bonds as an investment. You might have a correction in those bonds, but the supply-demand picture is going to be a problem. So that means other assets, a diversified portfolio of other assets.
I was with some Republican congressmen yesterday who were telling me that they are determined to block the request to raise the debt ceiling. Do you think that a new standoff around the debt ceiling or around Biden's stimulus package could spark another or a market sell-off or some kind of signs that investors are going on strike in relation to U.S. Treasuries?
I'm not sure if that particular case will happen or not. I'm inclined to be biased to believe that probably they will get past that and won't. However, I do believe that the nature of the political conflict that we're in is an increasing riskiness, an increasing brinksmanship, an increasing likelihood. For example, on the 2022 elections, I hear of talk of intentionally questioning the validity of those elections. These are things, there's a brinksmanship, there's an antagonism that is going on now that is threatening. And so it may not be that one, it might be that one, but things like that are an increasing risk.
So what sparks the crunch? I mean, if your argument is correct that we're going to basically see a fiscal cliff, jitters around the markets, maybe growth slowing down next year, which is followed by another round of quantitative easing, QE4, I guess that would be, or if not 5 or 6. What causes this to break?
What causes what to break?
Well, what causes this growing monetization, this growing attempt to simply keep pushing the debt burden bigger and bigger with zero rates? What will cause that to break?
Well, it's just like in World War II. What happens is over that period of time, you have an inflation rate which is much higher than the interest rate. And then you have controls. Just think about it. There's money is free. And the central bank can make it free. And it needs to be almost free. So think about it as a borrower. You don't have to, interest burden is no problem because you don't have an interest rate to pay. And if the Federal Reserve chooses to buy it, they may not they can choose to roll it forward. So the buyer the debtor may not have to pay anything in terms of that. How do you get it? In Europe and so on, there's no interest rate, and there may not be any principal payments, and that's the way it works. So that raises the inflation rate relative to that. The big risk of that happening is if they sell the bonds. In other words, if people investors start to think that there's a negative return, they're printing all this money, and then they start to sell the $23 trillion in bonds, then that forces the Federal Reserve to make up the difference or have interest rates rise, and then you can get a spiral, and that can be very bad for the dollar, too, as a reserve currency. That's the classic dynamic that we have to worry about. But the game never ends. It just keeps going, and the issue really is a low real interest rate and a confiscation of really value of wealth through that process.
Right. I didn't promise this session would cheer you up. One thing I'm very curious about is financial repression.
I think, I want to clarify something. Through these cycles of history, there is always an increase in the amount of debt relative to the actual value of goods and services. And it's not just debt, it's also equities. So the amount of financial assets that are owned, if you think how much financial assets do you have, is an enormous amount relative to the things to buy. And so so that amount will never be bought. That's what the run on a bank is, or that's when the bubbles break, is when you have so much more claims on goods and services than you actually have the goods and services to deliver. And so if you look at the amount of financial wealth that you all have, or we all have, relative to that, how will you convert that financial wealth? Financial wealth has no intrinsic value. So the only value it has is if you sell it or get money out of it to buy things. And that will never really happen because there's just way too much of it to allow that to happen. And so that is the risk. That movement where you move to say, I really want to convert it to things of value, and you get that kind of move. Classically, through all time, through all human history, really, that has been the big cycle. And so that's the big risk.
Right, right. Financial repression. I mean, Carmen Reinhardt and Spranzia wrote a brilliant paper a few years ago pointing out that when the debt burden was cut after World War II, it was done primarily through financial repression rather than just growth or austerity. I have a question though. I mean, financial repression is when you keep the interest rates below the rate of inflation for a period of time, creating essentially a subsidy from investors to governments. Can you have financial repression in an era of interconnected digital markets? Because you can't impose capital controls or financial controls quite so readily in a world where everyone can go out and buy Bitcoin if necessary. Is Bitcoin going to be the sort of safety valve or crypto assets that everyone rushes to in this world?
Well, let's take the financial repression. Yes, we are having financial repression, and we will have financial repression because that's how you deal with how do you make the payments. It's the things that we were just talking about. So you will have that financial repression just as you did in the 30s or the war years. The question of what people buy is a secondary question. Now, how they choose, basically the best things to buy are a diversified portfolio of things, of other things. Now that includes stocks, it can include real estate, it includes you want to be short cash. So it includes the anti-cash things. I believe in a diversified portfolio, and that's the strategic move. There are corrections in that, that's what I'm calling the mock charge, but those are the kinds of assets that you have. And if you look at history, all through that history, you always see that kind of dynamic when there's this set of circumstances. Because we need more money, and we don't have more money, and there's a limit to taxing. Taxing has produced revolutions in many cases. So nobody complains about this approach, right? Everybody's happy because they don't know where the money's come from. So nobody's taking money from anybody, and they then get the checks, and everybody's happy.
Well, the great thing about financial repression is that it's too complex for most voters to understand. But do you own crypto?
Yeah, I own some crypto, a little bit of crypto.
And what's your favorite crypto? Bitcoin, Ether? Combination of all of them, Cardano, Polkadot?
Please, I'm no expert. I mean, so anybody thinks that, okay, but I own some Bitcoin. Ethereum is more of a transaction. Yeah. In other words, I really do believe that the technology is fabulous technology, but that's different from what a Bitcoin is. Right. So I know a little bit. I'm into diversification, right? And so when I think about I own gold, so let me just take a survey. How many people own Bitcoin? Okay. How many people own gold? Okay, it seems like about the same number. And so if you think, I think how much, I want some of those, but I want a lot more gold than I want Bitcoin, and I don't want a lot of either of those two things relative to my whole portfolio, but I really I'm sort of an anti-money guy.
Right. We got that. Now, I have something on my lap called a Slido, which I have no idea how to operate. I'm an anti-tech person. So if someone is going to have to show me if there are any questions here or not.
You're an anthropologist.
Whether we're going whether we're going back to the old-fashioned thing of just waving a microphone around and if there are any questions. But while we're doing that, what about China? Two questions. One, your comparisons with the 1930s are not exactly reassuring. Are we heading for a war with China? Is that going to be the outcome of where we are, big picture, if you looked at debt dynamics? And then two, what about Evergrande? How concerned should we be? Is this a LTCM moment, a Lehman's moment, or can we just simply ignore it?
Okay, so let me take them individually. Yes, we are, the United States and China are in a classic great power conflict, and there are 5 kinds of wars, and they're not all shooting wars. There's a trade war, there's a technology war, there is a geopolitical war, there is a capital war, and there could be a military war. We are certainly in varying degrees in the first 4 of those types of wars, and there is worry, there's a good reason to worry about the 5th kind of war. I mean, that's just the way it is. And so that's the realistic answer to the question. As far as what's going on in China, I've been going to China since 1984, and I've been very, very lucky to meet with and get to know not only many Chinese, but many of the Chinese leaders, and got a perspective. And I think that there's a lot of misunderstanding about where they're coming from. If you can solve the riddle, and it's a riddle that you should have asked yourself to solve a long time ago, how can a communist Marxist policy government be having the second largest capital markets and having billionaires and so on simultaneously? Okay? And the answer to that was given, Deng Xiaoping said, it's glorious to be rich, and he said, it doesn't matter whether it's a white cat or a black cat as long as it catches mice. What he meant is as long as it works. And capitalism has been the best way of creating wealth around. But what it does is it creates wealth very unevenly, and it creates large wealth gaps, and it can get very overdone, which creates debt crises too. That's the history of it. And so the idea right now is the move to common prosperity. So there are, I think, some things one has to understand about China. First of all, it's a top-down, not bottom-up. It doesn't view a leader of China said to me, described it, he said, in the United States, the individual is of paramount importance, and everything builds up from that individual. In China, the family is of more importance. The idea of country, the word country, is state, family, and so it's like a parent, like a strict parent of a family. And so you get this top-down control, so it's very much top-down control going on, and we're getting now something that's like a micromanaging of that, like your children, can they watch video games or not video games? That particular question, an American might say that's an individual choice, and in China they would say that doesn't seem to be working, and we'll have the top-down. So this is going on at the same time as we're in a political year. In other words, preparation for the changes that'll take place at the 20th National People's Congress in terms of the leadership changes. That's just not Xi, it's the whole Politburo. And then we're dealing with simultaneously the control of data. They don't want the companies to control it, they want to control the data and a data policy. And then, so you're seeing all of those changes happening simultaneously. As far as the issue of the debt problem there, it's really been a sign of progress. When this new government came in, the Xi government, let's call it, which was 9 years ago, and I had interactions, 5 major banks lent to state-owned enterprises and local governments, and they all did it because there was an implied government guarantee. And so there's a lot of bad lending, and there was no development of small and medium-sized lending. Now what you're seeing is what's happening in China is the exact same thing that has happened many, many times in all countries, which is there was an excessive amount of lending, and they're going to let it run the way it is that we've experienced. You were talking about the 2008 financial crisis. This is not for China a 2008 financial crisis, but it's like our last crisis. You know how these things work. It depends how quickly the central bank comes in and intervenes, and so they make the system safe. They make the system safe. They make those who got themselves in that exposure pay the financial price. They do credit ratings and so on. This has been done before by China. Zhu Runji in the 90s had what they call the triangular debt crisis, and so they're going to work those through in the same way that we worked it through. If you look at all these debt crises, it's only the time that it takes the government to do it, when the debt is denominated in your own currency. So it took from 1929 to March 5th, 1933 for the Federal Reserve, and then the President of the United States said, we're not going to be held to the printing of money by our gold standard, we're going to print money. That took, in 2008 financial crisis, same thing happened, took about 9 months. In the last crisis that we went through, which was it took no time at all. So you know how the machine works. The government, when the debt is denominated in your own currency, you have the capacity to manage that debt, control the restructuring and so on, and that's what they're going through.
Well, thank you. We are sadly, very sadly, out of time, and since I'm still baffled by, unless the organisers want to go on for a bit longer, we do have a few questions. Do you want me to continue? Just looking at the audience. Carry on? Okay, well, let me ask some questions then, okay, and we'll run a little bit late. So, first question is, you mentioned sell bonds, but also indicated that a shift to selling could trigger the unraveling. How do you reconcile this?
I'm not clear on the question.
You mentioned that it could be time to sell bonds, but you said that could actually trigger an unraveling.
Well, to be clear, let's give the example in Europe. How is it possible for a bond to have a zero interest rate or even a negative interest rate and make profit owning the bond? Well, the way you could do that is you could borrow money at the more negative real interest rate and then buy the bond and you'll still make a spread. And that's the way it works, okay? So it doesn't mean that the bond price necessarily goes down, right? It just means it has a terrible return. So I'm not saying that you necessarily be short the bonds. We have to, that's a balance question, but it means that it's a bad return. What I'm saying is, so that's my position on the bonds. As far as, let's say, that risk exists. That risk exists that there could be a lot of selling of bonds. We have to be aware of it. We can see how the dynamic transpires. You would start to see upward pressure in long rates. You would start to see, again, acceleration of inflation type of things. And then you would see the Federal Reserve having an imbalance in bonds. And then they would have to be faced with the choice, like a currency defense. They would be faced with the choice of either buying the bonds to hold the rates down or having rates go up. And they will choose to buy the bonds and fill it in which case then things will get worse for bondholders.
Right. Well, two other quick questions.
Because don't look at your nominal return. Look at your real return.
Two other quick questions. Firstly, is real estate a good hedge for inflation? Should everyone here be loading up on yet more Connecticut properties?
Real estate is not a great hedge for inflation, ironically, because it also has the interest rate component. I think, and then in a difficult period of time, it doesn't have mobility like money. You can't move it from one place to another, and it has the interest rate risk as interest rates rise. So it's okay. It's an okay, but it's not an optimal investment.
So if you're a realtor, don't start cracking open the champagne yet. Two other last questions. Firstly, how will we know that inflation is not transitory? And the second question is, what should the Fed do about wealth inequalities? To which I would add a personal PS. given that QE is at the heart of a large part of this, in my view?
Let me take the second question first. Through all times, there are three types of monetary policy, and depending on how far you are in the cycle. Monetary policy first is interest rate policy. When you hit zero interest rate, this has been true throughout history. When you hit interest, then you have the Federal Reserve, which can't direct where money goes. They make the purchases. Those purchases come from investors, so they buy the bond. Those investors will buy other financial instruments, and those other financial instruments go up, and the money doesn't trickle down. Monetary policy 3 is the coordination between the central government and the central bank, because the government can determine where those checks go, just like we saw. But they can't produce the money, and then the central bank produces the money by buying those bonds, the debt monetization. That is where we are. So that's the mechanics of where we are, and so it will redistribute that money in that way. I think increasingly so. The first part of the question, which I forgot.
The all-important one that investors all want to know right now is give us an idiot's guide to knowing that inflation is not transitory.
Oh, okay. When it starts to be, I'll give you a few, but when cost of living increases start to be put into contracts, that is a good marker, right? There's a lot of transitory inflation going on now, shortages, supply chain problems, and so on. And then there's a lot of other money that is being, that now everybody can spend. And there's structural things like what's happening in the real estate. And there's a lot of quirkiness because the way we count real estate in there is on a rental basis. And for various reasons, the prices of houses have gone up, but not the rental values and so on, and they'll follow with a lag. So there's a lot of that kind of thing. And then I think the question is, what is that going to tell you? I mean, I think that you're probably going to have somewhere in the vicinity of a 4% inflation rate if you sort all of this out for maybe the next 3 years and so on. Okay, so what's the problem with that? The problem with that is what you're going to get on your other investments relative to that, because that'll be your tax. It's not going to produce a disaster at this level. If you get the spiral of the monetization, then it's a real bad thing. But if you have, let's say, a 4% inflation rate, the real question is, okay, so what exactly? Is that going, so recognize real returns is your issue. The problem is with the assets that you're holding, not necessarily that 4% a year inflation.
Right, well, thank you. Well, I don't think you've cheered us up, but you have given us plenty of food for thought, hopefully a compass with which to navigate the next year or so, and you've certainly left all of us, myself included, looking forward to the release of your next book, which is coming out when? Next summer? Or?
November.
No, this coming November. Well, clearly your productivity
you can
has
order
not
it.
gone
You
down.
can order it online now.
Okay, what's it called again, for those of you who want to rush off?
Principles for Dealing with the Changing World Order. The Changing World Order.
The Changing World Order. I'm sure it pairs fabulously with Anthrovision, but I had to say that, or my publisher will kill me. But anyway, I'm really looking forward to your book. Thank you so much for being so generous with your time, and we look forward to getting you back, hopefully next year. So thank you.
Thank you, Gillian, and thank you for the organizers of this who will have me. Thank you very much.